Here at Bitcoin Market Journal, we're revolutionizing the way people invest. Our approach combines time-tested value investing with cutting-edge crypto investing. It's the best of both worlds. And our strategy is super simple. We make monthly investments into a diverse portfolio of stocks, bonds, and up to 10% quality crypto assets, and we hold on to them for a minimum of 5 years. Over the long haul, this approach has far outperformed traditional investors who stay away from crypto. We affectionately call them the non-believers. Today, how to value crypto investments. In our last video, we talked about the principles of value investing. Now on to crypto, where the same principles apply. The first principle, cryptos are like companies. Although in many ways they're different from traditional companies, it's most helpful to think of cryptos like companies. Then we can apply the principles of value investing with a few tweaks. This lets us analyze cryptos like companies. As we covered in our last video, we can use qualitative analysis, or our judgment about a crypto company, as well as quantitative analysis, or the numbers. In fact, crypto companies are way better than traditional companies in this respect, since crypto numbers are transparent and real-time on the blockchain. There's nowhere to hide. Now we can use tools for both. For qualitative analysis, Bitcoin Market Journal has created the industry standard scorecards, including our blockchain investor scorecard, our blockchain risk scorecard, and our NFT investor scorecard. These are downloadable PDFs that you can use to value crypto companies yourself. Our analysts use these for our reports too. For quantitative tools, see our guide on how to read crypto financial statements. For now, we'll just say that user traction is by far the most important metric. Because all blockchains have network effects, the most important thing to ask is, are they attracting real users and keeping them? This can help you eliminate the vast majority of crypto tokens right away. Remember, real users equals real value. Tokenomics can build or destroy your value. There are no rules for creating new tokens, so a company that constantly creates new tokens dilutes your value. Let's say a crypto company has 100 tokens and you own 10 of them. You own 10% of the company. But let's say they keep creating new tokens and now have 1,000 tokens. Your 10 tokens are now worth just 1% of the company. So bad tokenomics are inflationary, good tokenomics are deflationary, or at least manage inflation well. And by the way, this is also what happens to the value of your money when the government continually prints more of it. So this is a very quick overview of how to find rewarding crypto investments. But you've also got to manage the risk. That's what we'll cover next. Keep watching.